Okay, Assalamualaikum warahmatullahi wabarakatuh. So we from group 3 will present about the CC1. So our group member is, the first one is Muhammad Hanif Basha bin Muhammad Aisyah. The second one is me, myself, Muhammad Syafiq Fahmi bin Helmi. The third one is Nur Akilah binti Muhammad Noor. And the fourth one is Siti Farahana binti Zulkifli. And the last group member in this group is the Mariana binti Muhammad Nasir Osman. Okay, so in this presentation we will present about the question of from the question number 3, after that question number 4, and then we go to the question number 10, and then we go, the last question is question 11. Okay, so the first one will go for the first presenter to the introduction. So let's go.
Assalamualaikum warahmatullahi. My name is Muhammad Hanif Basha bin Maisha. I will introduce about the exposure draft. What is exposure draft? Exposure draft is a document issued by the Financial Accounting Standard Board (FASB) to obtain the public comment on the emerging revised accounting standard in order to mitigate the potential adverse effect before it becomes law. It reflects the decision considered by the FASB on a particular accounting issue, such as disclosure, goodwill, and impairment. Comments are more likely to provide by specialist accounting company and business group with extensive experience of how the proposed norm will impact their customers. Based on the data received from the letter of comment, the FASB can amend the draft exposure until it becomes a statement of opposition and finally a necessary financial accounting standard (FAS).
So I will continue with question 3. First of all, let me introduce myself. My name is Marina binti Muhammad Nasir. My metric number 264962. So the question is, paragraph 2.53 until 2.60 explain the board's preliminary view that it should develop in addition to proposed new disclosures requirements. Proposal to add disclosure objective to provide information to help investors to understand the benefits that a company's management expected from an acquisition when agreeing the price to acquire a business and the extent to which an acquisition is meeting management's objective for the acquisition. Do you agree with the board's preliminary view? Why or why not? So my answer is yes. The proposed new disclosure and new disclosure objective regarding benefits of acquisition when agreeing the price to acquire a business, also the extent to which an acquisition is meeting management objective for the acquisition are very acceptable. This is because the information will help investors to understand more about the acquisition and will increase management's stewardship respectively. So I will pass to the next presenter. Thank you.
Assalamualaikum and hi, my name is Nur Akilah binti Muhammad Noor. My metric number is 264297. I will be commenting on question 4 of business combination on disclosures, goodwill and impairment. Paragraph 2.62 until 2.68 and paragraphs 2.69 until 2.71 explain the board's preliminary view that it should develop proposals to require a company to disclose a description of synergies expected from combining the operations of the acquired business with the company's business, when the synergies are expected to be realized, the estimated amount or range of amounts of the synergies, the expected cost or range of costs to achieve the synergies, and to specify that liabilities arising from financing activities and defined benefits pension liabilities are major classes of liabilities. Do you agree with the board's preliminary view? Why or why not? So this is my answer for the question 4. I agree with the board's preliminary review that an organization should be expected to disclose a review of the synergies. The investor claim information on nature was presented in paragraph 2.63. The timing and the amount of expected synergies are important. It will be enable investors recognize the benefits required by a company management when compromising on the cost of obtaining a business. The details also will help investors to hold management to account for the performance in achieving synergies. Nonetheless, it may be challenging and highly judgmental to measure anticipated synergies when the stakeholders are concerned about the auditability of synergy information. Besides, in paragraph 2.67, it shows board will not intend to disclose businesses to meet detailed plans for the realization of the synergies. The board expected there will be limited commercial sensitivity needed to be reported by the company. I acknowledge that auditing should be feasible as it sufficiently transparent and detailed in the framework against which the disclosures are audited. However, it advises that International Auditing and Assurance Standards Board (IAASB) address auditability. That's all from me. Thank you.
My name is Muhammad Shafiq Fahmi bin Helmi and my metric number is 264184. Okay, for me I will present about the question 10. Okay, the question 10 will sound like the board's preliminary review is that it should develop a proposal to remove the restriction in IAS 36 that prohibits company from including some cash flow in estimating value in use cash flows arising from a future uncommitted restructuring or from improving or enhancing the asset's performance. And the second one is to allow the companies to use the post-tax cash flow and the post-tax discount rate in estimating the value in use. And the board expects that these changes would reduce the cost and complexity of impairment tests and provide more useful and understandable information. So we go to the next slide. Okay, we have two questions, which is the first question is that the first one, should the board develop such proposal, why or why not? And the second question is, should the board propose requiring discipline in addition to the discipline already required by IAS 36 in estimating the cash flow that are the subject of this question? Why or why not? If so, please describe how this should be done and state whether this should apply all cash flow included in estimate the value in use and why. Okay, for the first answer, for the question 8, the answer is, from our opinion, the board can comply with the proposed elimination of any cash flow constraints, because when there is a concern, however, that will encouraging a business to provide a cash flow from the potential restructuring or other investment of assets will further the prolong of identification of impairment losses due to exercise ambitious the cash flow projection. Okay, the second point is this might slow the identification of deficiency losses further, means that it also may be challenging and judgmental to assess whether cash flow from potential restructuring or changes in the assets are fair or appropriate. Okay, for example, it may not be possible to adequate such projected potential cash flow with previous cash flow forecasts in view. The view equation as required by paragraph 34 of IAS 36 for other form of cash flow. The guidance on whether the cash flow from uncommitted the future consolidation or upgrade of assets means that it is fair and supportable. It is really required. And then the next point is to take into the consideration of the highly likely advice in IF estimated restructuring timeline. And the last one is the management must essentially be able to show its intention, determination, and the financial skill. Okay, we go for the second question. The second question, our recommendation. The AASB encourages the use of discount rate either before or after taxes, but clarification is really important. While conceptually a post-tax discount in cash flow and a pre-tax discount in cash flow can give the same outcome, in fact that is only if there are no temporary variation. Means that if the business uses a discount rate after tax and after tax cash balance, the reversal of temporary discrepancy is to be assumed and the timing thereof. After that, this guideline should clarify that if a corporation wants to use a discount rate after taxes, it would still have to ensure that the sufficient cash reserve are defined after the tax and represent the real cash flow that are projected to be obtained from the investment after taxation. To easily understand, the estimated post-tax cash flow will include comprehensive reverting plan, and the resulting recovery value must be compared to the CGU. It also includes any deferred tax balance to decide whether there is any default if a company use a profit tax discount rate or the post-tax cash flow. Additionally, the view guidance model is required in order to handling of other products such as leasing liabilities and asset retirement, the commitment under the view model itself. Okay, the next slide. For example, where cash flow and the carrying value of associated assets and liability are to be included or omitted in. Okay, after that, when it is needed to be included or omitted, while the majority of the stakeholders did not comment or endorse the retention of two separate models, whether it is necessary or not, it might eliminate any decision from one model and also would answer the question about the undue confidence in the view estimate itself. So accordingly, the ASB has recommended that the IASB to carry out more studies. So that's all for question number 10. Thank you.
Assalamualaikum, my name is Siti Farhana binti Zulkifil 264814. So I will present for the question 11. Paragraph 4.56 of the DP summarizes the ISB preliminary view that it should not further simplify the impairment test. For the first question, should the ISB develop any of the simplification summarizes in paragraph 4.55? If so, which simplifications and why? If not, why not? For the answer, Board should not develop any of the following proposal as stated in ISB preliminary view as to not add any further guidance on allocating goodwill to cash generating units. The proposals are: first, adding more guidance on the differences between entity-specific input use; second, mandating only one method or estimating the recoverable amount of an asset, or requiring a company to select the way the company expects to recover an asset; and the last one, allowing companies to test goodwill at the entity level or at the level of reportable segments. For the question 11b, it asks, can you suggest the other ways of reducing the cost and complexity of performing the impairment test for goodwill without making the information provided less useful to investor? For the answer, as stated in question 6, the ISB could assess whether to introduce additional guidance on the allocating of goodwill to CGU, which could result in a more effective application of the impairment test by introducing the guidance of how goodwill is allocated to cash charity units. Furthermore, it may be useful for users as it provides useful information about the prospect of a CGU which could improve their valuation for the businesses as a whole when looking at components.
In conclusion, there are comments that agree and disagree with the exposure draft. It because for disagree part, they did not want the board to add some requirement in the draft. Some of the requirement will slow the identification of that particular item. However, there are some of the requirements will give the advantage to the investor for them to make a decision. Then, some of the requirements that can recognize the benefits required by the company easily. So, the FASB need to consider about the comments that were given above because it will affect the stakeholder. Thank you.